Let's see how we can evaluate a firm's profitability using financial ratios. So here's DeLeon's balance sheets, its income statements, some other data as well. So here we have three profitability ratios on this slide: operating margin, profit margin, and basic earning power. So operating margin tells us what percentage of each sales dollar is left after we've paid all our operating expenses. And it would be about a nickel out of every sales dollar, or 5.1% of every sales dollar is left over after we've paid all our operating expenses. Profit margin takes into consideration all of our expenses. So we take net income divided by sales. So for DeLeon in 2020, we have a 3.71% profit margin. And basic earning power is, again, taking our operating income, but now dividing it by total assets. So we can see that in each one of these three measures in terms of profitability, that in 2018, not quite as good as the industry average. 2019 was just a horrible mess, and the forecast is that it will at least be in the positive column. Still not as good as the industry in any one of those three, but a lot better than 20. So all in all, we can say that the operating margin was very bad in 2019. It's expected to improve in 2020, but again, still below the industry average. Profit margin was very bad. And when we go from operating income to net income, we know that we have to consider that interest expense. And man, that was really huge in 2019 because the firm had so much debt on its books. So it's projected to improve in 2020, the profit margin, but still below the industry average. Now, what about this basic earning power? It removes the effects of taxes and that borrowed money, and it's useful for a comparison. It's projected to improve, but again, still below the industry average. We look at return on assets and return on equity. Return on assets measures how much net income we can produce with our total assets. So in 2020, that's about 7.31%. Return on equity represents how much income we're earning on behalf of our stockholders. We're not paying them that, but this is what we're earning on their behalf. So net income divided by our common equity is 13.1% for 2020. Let's see how this holds up. Well, 2018, decent. Not great, but decent. 2019, huge mess. And again, if the firm can reduce its debt and this burden of paying all the interest on the debt, they can sell stock, use the proceeds, extinguish the debt. That's going to help a lot, and they'll be able to see the light of day on 2020. Still off the industry average, but at least they're alive. So all these ratios rebounded from the previous year, but they're still below the industry average. Some improvement is needed. There's some wide variations in that return on equity, and that shows you what kind of effect that interest expense has, that leverage that borrowed money has on profitability. So, in terms of return on assets, holding assets constant, if the debt increases, the equity declines. And if debt increases, that means that they have to pay more interest expense. More interest expense means the bottom line, the net income, is smaller. So whenever we use that net income figure that's burdened by all this interest expense, return on assets, return on equity, not going to look so hot. Return on assets declines because of the reduction in net income. Return on equity, well, it didn't look so good for 2019. That's certainly true. It depends for some firms because both net income and equity declines because of so much debt. So ROE, return on equity, and shareholder wealth are correlated, but problems can arise when ROE is the sole measure of performance. It doesn't consider risk. It doesn't consider the amount of capital invested. So, unfortunately, it sometimes can encourage managers to make investments that don't benefit shareholders.